Today we're going to be talking about Freeport-McMoRan, or FCX as it's known on the New York Stock Exchange. The topic, copper supercycle or fully valued. Copper may be one of the most strategic commodities of the next decade. Think electrification, AI infrastructure, data centers, grid expansion, EVs, defense spending, all roads lead back to copper. At the 2025 Business Summit at the University of Southern California, Marshall, billionaire mining entrepreneur Robert Friedland delivered a tour de force dissertation on critical minerals and the raw material supply chain. His message was clear and sobering. The world has an insatiable thirst for metals, from surging military budgets to AI data centers and the greening of the global economy. But it doesn't have a credible way to supply the metals it intends to consume over the next few decades. In relation to copper, he said that we have to mine the same amount of copper in the next 18 years as we mined in the last 10,000 years combined. That's an incredible statement. In the next 18 years, we've got to mine the same amount of copper as we mined the last 10,000 years. And that ignores electrification, data centers, solar and wind, and the greening of the world economy. He said, "You people have no idea whatsoever of what we're facing. You're dreaming." That is sobering. And when investors think about large-scale copper exposure, one name immediately comes to mind: Freeport-McMoRan, or FCX. FCX is the world's largest listed copper producer. Despite very strong stock performance, we think FCX is approximately fair value at the moment, even after adjusting for temporary operational disruptions. In this video, we'll explain why. First, our disclaimer. Please note, this video and note is intended to be general educational content and not investment advice. We do not take responsibility for the content, which may contain errors. You should always do your own research and obtain professional financial advice tailored to your own circumstances and risk profile. What FCX actually is. FCX is not simply a copper miner. It's really a portfolio of giant long-life copper systems spread across the United States, South America, and Indonesia. The crown jewel is the massive Grasberg mine, one of the largest copper and gold deposits ever discovered. FCX also owns major interests in the Marinchi mine, Cerro Verde mine, and El Abra mines, all in South America. And importantly, FCX is also a meaningful gold and molybdenum producer. The Grasberg distortion. One of the most important things investors need to understand is this. 2026 is not going to be a normal earnings year, just as 2025 wasn't. Production has been impacted by operational disruptions at Grasberg caused by a gigantic mudslide and cave-ins in 2025. This significantly affected production and revenues last year. However, the company has told us that things are normalizing and that we should be back at normal production over the coming months. So current year earnings are likely to underestimate FCX's normalized earning power. Our steady state assumptions ignore the temporary outage and assume approximately 4.2 billion pounds of copper production this year and stretching out over the foreseeable future. Gold production at 1.8 million ounces, or 1.8 billion ounces. Molybdenum at 90 million pounds per year. The copper price assumed is $5 per pound, $4,000 gold price, and a $25 molybdenum price. So we estimate a normalised EBITDA of approximately $14.5 billion annually. By comparison, during the Grasberg disruption period, we estimate that the EBITDA was closer to approximately 11 billion. So with Grasberg, we've only got 11 billion of EBITDA. Without the Grasberg outage, the normalised EBITDA is around 14.5 billion. So 3.5 billion difference. So we incorporated the normalised EBITDA cash flow from year 2 onwards, from 2027 onwards. Quite important in valuing Freeport is the hidden gold effect. And this is where FCX becomes especially interesting. Most people think of FCX as just a copper miner, but economically the gold matters enormously. As we said, Grasberg is not only a massive copper mine, but it produces a huge amount of gold. Gold is important because it acts as a byproduct credit in FCX's accounting. In simple terms, FCX treats gold revenue as an offset against copper extraction costs. Since Grasberg produces so much gold, it reduces FCX's effective copper production cost incredibly. So if you look at this page, we've assumed that under normalised conditions, the net cash cost of production, the total group's production, comes down to between $1.25 and $1.50 per pound. Production cost of roughly, let's use the midpoint of $1.40 per pound of copper extracted. That's a very low production cost, especially if you compare that to our assumed realisation price of $5 per pound. That gives you a margin of in excess of $3 per pound. And if you compare it to today's copper price of in excess of $6, it's $4 a pound. So FCX is minting money at these prices. Production costs are low. A lot of this has to do with the gold price. During the Grasberg outage, gold production fell, byproduct credits fell, copper costs rose materially, more towards $2 plus per pound. It's still low. But this shows you how FCX's earnings can swing so dramatically. But going forward, we think that provided these problems in Indonesia, in Grasberg, normalise, the group is looking good at a very low production cost profile and very high profitability given the incredible demand for copper going forward. There is an important thing that most investors miss, and this is probably the most important part of the analysis, and that is that FCX does not economically own 100% of all of its international mines. Most of its US mines, if not all, are owned 100% by FCX, but for example, it only owns 49% of the Grasberg mine, and this percentage is reducing by about 1% per annum for the next decade, so that FCX economically will own only 39% of Grasberg in a decade. It has operational control, and that's why it's 100% consolidated. And likewise, the Morenci mine is only owned 72% by FCX. Cerro Verde in Peru is only owned 55% by FCX, and El Abra in Chile is owned 51%. So while FCX consolidates 100% of these operations for accounting purposes, a very large proportion of the economics belongs to joint venture partners and non-controlling interests. And this matters enormously when calculating intrinsic value, because when investors value FCX on an EBITDA multiple alone, they can accidentally overstate the value attributable to FCX shareholders. You need to deduct the value of the non-controlling interests. The non-controlling interests are shown at historical cost in the balance sheet, so it's not easy to do this. The way we did it is to essentially calculate the enterprise value for each of the major mines FCX does not control 100%. And we then, having calculated the intrinsic value or the enterprise value for, let's say, Grasberg, we then deducted the 51% of the value of that mine from Freeport's overall enterprise value. So we'll now talk about our valuation framework. Using our assumptions that we briefly mentioned before, our pricing assumptions, for example, $5 copper, $4,000 gold, and $25 molybdenum, and various other assumptions, we came to a enterprise value for the whole group, FCX, of $143 billion. We then deducted the claims against this intrinsic value or enterprise value by deducting net debt, which in this slide you can see is roughly 11 billion net debt. As you can also see, the value of the non-controlling interests in Grasberg is close to $19 billion. You need to deduct that from the 143 billion. And likewise, the non-controlling JV interests in the Americas have over 16.5 billion. The net claims against the total enterprise value, as you can see, total to around $49 billion. So having calculated consolidated enterprise value of 143 billion, we need to deduct from that this 49 billion to give us an intrinsic value of the enterprise of $93 billion. Current market cap today, 22nd of May, is roughly 90 billion, 89.9. So we are pretty much trading on our calculation of intrinsic value. It gives us some comfort that we've done something right in our calculations. Our calculations assume $5 copper price, $4,000 gold price, $25 molybdenum price. As we said, the gold and the molybdenum are normally shown as credits against input costs, the production of copper. But at the moment, copper is trading at $6 plus. Likewise, gold is trading at $4,500 an ounce. On today's prices, if you're extrapolating from today's prices, you might think it might be worth more. So just to summarize, our view is that FCX appears broadly fairly valued under our base assumptions. That said, there is a bull case. Absolutely. And it's substantial. If copper prices move materially above $5 per pound and remain there for years, not months, FCX's earnings power changes dramatically. Remember, every additional dollar in copper price flows through as billions of pounds of annual production. And because mining is operationally leveraged, incremental margins can be enormous. Long-term copper scarcity is also real. At lower copper prices, reserve lives shorten materially. At higher copper prices, more resources become much more economic. That optionality has value. As an example, the company has said that at a long-term copper price of only $3.25 a pound, a conservative estimate, their reserves would be roughly equivalent to 27 years of normal production. At only 50 cents more, if the assumption is increased by only 50 cents to $3.75 a pound, this increases reserve life by another 12 years to 39 years. At our assumed price of $5 copper, reserves would be much greater, much greater. I would hazard to guess that it would be double, 80 years. Don't hold me to that, but it would be materially bigger, larger than the 39 years. Current prices of $6, we haven't done the calculations, but there'll be no problem in relation to it really just comes down to the acreage that Freeport has, because a lot of previously marginal projects that they would have and own would become economic at these levels. Well, that's the upside, but we need to talk about risks as well. There are always major risks in mining. These include, I'd say that the biggest risk would be sovereign risk in Indonesia. We said that currently Freeport's economic interest in Grasberg is 49%, slowly going down to 39% over the next decade. No doubt Freeport has expended a lot of its a lot of resource and effort over the years to keep a great relationship with the Indonesian government. And the fact that it has full operational control of the mine and all the know-how suggests to me that it's, whilst this is a risk, it's not a major risk. And it would be incredibly foolish of the Indonesian government to displace Freeport. But it is something we just need to keep at the back of our mind. And this applies to the other offshore mines in South America. We just need to keep these risks in mind. Probably more on point for the current environment would be cost inflation and energy market disruptions. For example, the inflated energy costs resulting from the current Iran conflict. The longer this conflict continues, the more the chance of a global recession and the ongoing risks to industrial demand for copper. So copper has always been a cyclical commodity. It still is. And for me, a recession would be the ink in the ointment in the short term for the price of the stock. Our research is showing a global copper market which is quite balanced, where supply and industrial demand are roughly in sync. Part of the recent price strength may reflect inventory accumulation, strategic stockpiling, and speculative positioning ahead of anticipated future shortages. So we've got hoarding of the commodity, no doubt. We've seen some private ETFs, public ETFs, and even warehousing of physical copper in anticipation of future demand by non-industrial users. And that is keeping the price going up. The price goes up, not because industrial demand is exceeding supply, but rather because non-industrial demand, speculators, investors are buying it up and holding it. A global recession caused by high inflation and energy prices, though, may knock the wind out of the industrial demand for copper, as I said before, and may be enough to also knock the wind out of the speculative market as well, which may be leveraged. And so, as I say, FCX is not a utility. It's a highly cyclical global resources company, and you don't want to buy these type of stocks at the top of a cycle. So in conclusion, where do we land? We believe FCX is a world-class copper asset base with enormous long-term strategic relevance, but currently trading broadly around fair value under our assumptions. Very attractive though, if you believe the $6 plus current copper price is here to stay. The stock could become extremely attractive during operational disruptions, a commodity panic downturn, or broader market sell-offs. Copper is cyclical. But at current prices, we think investors should remain disciplined and value-focused. Diving in headfirst and buying the whole position at these levels might be risky. If you really do need to start buying it, like we love the stock, we'd rather dollar cost average and accumulate on weakness rather than going in head first. Because in mining, as investing generally, the quality of the asset matters, but the price you pay matters much more. If you enjoyed this deep dive, please like and subscribe and follow us at our Substack, the Wealth and Wellness Code, with a link provided in the comments below. Thank you for listening.